Welcome to a special edition of Tariff Talk. This one we're bringing to you just hours after President Trump announced, I think it was a pause, not a cancellation, actually kind of confusing. I'm here with Dr. Michael Hicks of Ball State University. And Dr. Hicks, can you just kind of walk us through, from your perspective, what was announced?
So the official announcement today was a pause of what he's calling retaliatory tariffs on 175 or so countries other than China. And so those are the tariffs that were part of this magical mystery formula that was used last week to arrive at a particular rate on each country that was supposedly designed as a way to balance trade with them. It does not eliminate the 10% baseline tariff that remains on at least all imported goods. So everybody is now going from whatever their tariff rate before, which is typically 0, to 10%, except for China, which is now, I think, 104, 125%. It's hard to keep up with the dazzling array of consequentially different policies in this administration.
Okay, so why do you think that change was made?
As of middle of yesterday, we began to see really unnerving financial market conditions. And they sort of took place in two ways. The first one was that most of the volatility that was driving stocks was because of low liquidity. So there were companies offering stocks for which nobody was willing to buy. And so without them changing price, there was no downward pressure on the market, and there were firms that were using excess cash to find what they thought might be more beneficial stocks that would survive the tariffs better. So there were a lot of volatility. That lack of liquidity in financial markets, in equity markets, so Dow Jones, the stock markets, is really sets us up for a big crash. That's the sort of thing that brought about the 2008 crash, the 1987 crash in stock markets. So that's one part of the problem. And then yesterday evening, last night, and then first thing this morning, foreign owners of domestic bonds, American bonds, primarily government bonds, federal government bonds, but also local government, municipal bonds, and some commercial bonds, started dumping them in pretty big numbers. So we saw a reversal of lower long-term rates, which happen when you expect a recession, to very high rates. That suggests that people who were previously holding these very secure assets that most people would retreat to during a period of stock uncertainty were actually leaving the U.S. Financial market for bonds. So that means that we're risking liquidity crisis in both the stock and the bond market, which is the type of thing that sets the table, as you will, for a financial catastrophe that would require sort of, freezing trading, Federal Reserve jumping in to do emergency measures, the sort of financial crash that you saw in 2008 or 1987 or frankly 1929.
Okay, so you used two terms there. I just want to maybe have you kind of explain them in more detail for the people that aren't as they don't have an economist they can call up and ask questions to. Liquidity and then bonds. Can you just define those for us?
Right. So liquidity is just the ability to turn that financial asset into cash. And so if I own stocks and I'm an institutional trader and I think the stock's going to drop, I want to be able to sell it. And then maybe I want to buy something else, typically a bond or a more secure stock like a Walmart. So if I'm owning parts of GM, the benefit of putting in a stock market is I could sell that anytime. Yeah, maybe it would go down in price. Maybe I would lose some money, but I'm not going to lose everything because I can always pull my money out and put it somewhere else. And a liquidity crisis means, look, there's no buyer for this. You can't at the current price or even lower prices. There's nobody even bidding on that stock. And so many of our very trade exposed companies then probably had no potential buyer for. So that really would have spooked all types of institutional investors and people who were counting on that liquidity. A bond, and that idea of liquidity holds in both the bond and stock market. In a a bond, and most of the bonds we're talking about are U.S. Treasury bills that finance our $34 trillion debt. And countries and businesses and households around the world like to hold this debt because Americans are going to pay it off. And so they like to hold it. It's secure. It's denominated in dollars, so it's not very volatile. The pressures on the U.S. economy from these tariff announcements, the starting of a trade war, which is not like previous trade wars that were between all countries everywhere. This is a trade war of the United States against everyone else. Meant that foreign holders of these bonds, which include almost people in every country in the world, institutional investors in Europe and China, and governments around the world that hold different stock portfolios to hold cash in, started dumping these, apparently started to dump these. And as they dump them, the long-term yield goes up because you have to pay more, you have to get more on these bonds. In the long run, the value of them drops. And we might say, as Americans, we might say, who cares about that? Well, the problem is that if these bonds come due, almost every day, all the time, and the new ones that get let under a high, we're having to pay a higher interest rate to get people to buy them than the ones that are being cashed in. And if that's the case, our borrowing costs, which are sitting at about 12 or 13% of GDP, are going to skyrocket. So it could really accelerate a federal budget debt crisis. And so in terms of the long-term effect of this is that what was happening in these markets, we were because of the concerns over American economy, we were seeing stock prices drop. We saw American bond holders of American bonds leave the market, and together that's a risk of a financial crisis that would cause our borrowing rates to go up. A way to think about it is if you own a credit card and you lose your job and you go back to them and you tell them, look, I need more money for my credit card, they're going to increase your rates. Or they're going to say, look, you're not very likely to pay this back. So, yeah, you can get a credit extension, but I'm going to take you from, 8-9% to 12% in order to borrow that money. Or if I'm taking out an emergency loan on my home equity, those rates are going to be higher if there's financial distress in your background. So that was what was happening. And again, we weren't there, but the Wall Street Journal reported on it this morning, this liquidity crisis brewing, setting the stage for a financial crisis. And I think somebody got a hold of the president, God knows who, because his trade advisor was in the middle of Congress explaining why this was a good idea. And Peter Navarro was on the internet, on TV explaining why this is a good idea. Somebody said, look, we'd be a day or two away from, or a few hours away from a big financial crisis. It could happen overnight if you don't do something. So he did something.
So just to kind of circle back with stocks, that's something that somebody buys a small portion of a company and they do that expecting the value of that to go up, and then later on they'd be able to sell that. What you were saying earlier, the liquidity crisis in terms of stocks, people were not able to sell the stocks that they wanted to get rid of because there weren't people willing to buy them. Whereas with a bond, you've got people who are essentially helping the government borrow money because the government can't go to a bank and borrow that. So somebody takes a small percentage of that and says, hey, I'll pay you, $100. And then in 20 years, you will pay me that plus some interest. I remember when I was a kid, people would get savings bonds. It sounds like kind of similar to that, or maybe the same thing, but the bond market was in a free fall, and people were worried that the United States was not going to be able to continue borrowing money at the rates that it is. Am I on track there?
I think that's about right, and it's good. The savings bond is a good way to think about it. These bonds pay a low yield because they're safe. And so if you think that, gosh, they may not be safe, maybe the United States is going to be in a financial crisis, and maybe they're going to just accept inflation to pay off these bonds. And so that's going to eat into the face value of that bond I'm going to get back in 10 years, then maybe I want to get rid of it. I don't trust that. And so the loss of that, the movement away from that was severe enough overnight to really spook some people. I think, and we were setting up to see that overnight because remember, this is mostly happening in after hours. These are traders overseas who are, removing these bonds, and so it doesn't mean our debt goes away. It just means the servicing costs go up on it over the long run, and so. It also means in the long run, and this is a sort of bigger picture, the world may be viewing us as no longer the stable security that is really the global security that we need to move on from trusting America to be a careful steward of the economy and looking for some other currency to replace it.
I want to talk about a word that's come up a lot lately, and that is stability. I think when we go through a period just over the past few days where, the market is very volatile, as people are talking about, there's people who are emphasizing the importance of stability, not just to the financial markets, but to our economy as a whole. Can you talk about why stability is so important and how it impacts things outside of the stock market and the bond market?
The word that I like to think about when you're thinking about the stability is really certainty. And that is, so if I'm a business and I know I'm going to get a higher tax, I can build that into my expectations. I can make adjustments. I can plan. I can do things with my company to offset the cost of it. I can talk about prices with my customers, with those from whom I'm buying, and normally muscle my way through a small change in taxes. Or if I'm negotiating with my union, a change in benefit packages or wages I can work through. American businesses, American households are very good at adapting to changes that they predict and see that it's one of our magical skills of being a very market-intensive economy. And you take uncertainty, you throw it in to us, what you're really saying is we don't know what's going to happen for good or ill. And so we normally think about uncertainty as a bad thing, like higher rates that are going to spike up on us, and so that would higher tariff rates or something, and that would spook a lot of business investment. So, and by business investment, that's a fancy way of saying, should I buy new equipment, new computers for my factory? Should I upgrade the fleet? Probably would like to get new tires on my trucks, and I need a new dump truck for the business. Should I do that? All the way to should I build a new franchise? And so the accumulation of high uncertainty means, particularly about these bad events, that maybe I'm going to delay many of these decisions. And in some decisions, you expedite. So in the case of higher tariffs, you might say, well, I'm going to expedite buying my new fleet. So we saw a big spike in demand for transportation equipment, for example, in January and February, that was probably linked to concern over higher prices in the future. And so households value certainty over uncertainty. But the economic effects of uncertainty are also on the upside as well. And so, I actually think one of the reasons why the stock market didn't fall more quickly is that most Americans thought the president would eventually back away from this if he's calling it a negotiation stand or whatever. I think we can debunk the idea that this was supposed to help the economy, because clearly it didn't, and clearly he wasn't willing to stick with the short-term pain for the long-term gain. So I think most Americans, particularly stock owners, thought, well, this is not going to last. This Congress won't let this. Certainly it won't happen. And so in that environment, if you think you want to buy an American product or sell to America, maybe you just wait 3 months. Maybe you just hold that ship in dock. Maybe you delay. So Jaguar recently announced they're not going to ship cars over there, stopping their shipments to North America. And BMW said they're not going to move shipment. China has stopped shipping goods. They've turned ships around in the middle of the Pacific. And that uncertainty is driving those blocks in supply chain. And so you might say, oh gosh, is that important? Well, those thousands, millions, hundreds of millions of microeconomic decisions like that add up to causing delays in economic activity that are unproductive, or rush forward decisions like buying a fleet earlier than you needed them that's unproductive. And altogether, that really jars the economy. So even, the fact that the president has said, well, this is a pause, a ceasefire, as you will, that doesn't mean that that's going to change the business decisions of Canadian firms or Mexican firms or German firms who are thinking about doing business with America. They're going to say, I don't want to be part of this. I don't want to pay the tariffs to sell you goods, and I don't want to pay the tariff coming back if my country decides to put a retaliatory tariff on you. So I'm just going to go somewhere else where there's not a tariff. So what Donald Trump has done has made stuff that Americans are selling overseas more expensive to buyers, and has made stuff that we want to buy more expensive for American consumers. So we're still talking about an average tariff rate that's 4 times what it was on January 19th of this year for Americans. It's really a very damaging set of public policies, both from the cost side, the real bottom line costs of paying higher taxes as we import and export goods, and on the uncertainty about just what sort of weird hormonal middle school behavior are you going to pull out between now and Friday to justify some policy change. You've changed the tax rates on China 3 times in 7 days. That's just inconsistent with that looks like a 16th century potentate from Turkey, not a modern, confident global economy and world leader.
So the idea that what happened today was a rollback of the Trump tariffs, that's just not accurate.
No, it's at best a ceasefire that is taking place after you've already conquered part of a country. That sort of, we're going to give you 10% tariffs. Well, some countries that was the whole tariff. So for maybe a third of countries, this is no different than it was before. For some countries, the tariff rate was, like in Vietnam, it was 47%. So that gives Vietnam, which was one of our key allies in moving supply chains out of China, right? Vietnam, our tariff rate was 47%. So, a number of American firms had moved their company out of China to Vietnam in order to diversify our supply chain, to strengthen the economy of Vietnam, which has been a traditional enemy of China and growing far closer to the United States, trying to adopt market-based economy. And now we put a 47% tariff on them. That was just going to shock their economy into recession. And now they've got to be saying, look, I don't want any part of American investment. I want to be welcoming Canadians and Mexicans and Brazilians and Germans and the Brits. What Donald Trump has done has not changed that business, the very cold-hearted business calculus of how profitable is it going to be making these trades? Where should I be going in the long run? And I don't think anything he can do is other than sign a bill by Congress to take away his tariff authority is going to restore that certainty.
Okay, so I'm going to ask you to make an assumption, and it's probably not a good assumption, but let's just say that today is the last movement on tariffs that we have for the next foreseeable, maybe the rest of the Trump administration. What kind of impact would we see just from, if things stay, if we can have certainty after today? Was this a blip, or is this something that's going to take a long time for us to recover from?
I think there's been enough damage. Let me back up. Let me caveat my answer with, if tomorrow he says, I was wrong, 10% tariff is all I'm going to stick with, and I'm going to ask Congress to codify that and take away my unilateral authority to raise or lower tariffs. If he actually did that, I think it would carve, so we got certainty right now. I think it would carve in this year, carve 1% to 1.5% off our GDP growth, taking us from maybe 2.2, 2.5% down to 1%, maybe less in GDP growth this year. Not quite a recession. It could spill over into a recession. It depends on how strong financial markets recover and whether or not most other countries actually believe this. So at the very best, we're talking about growth slowing from what should have been at 2.5% down to 1% or less. That's the best case scenario. And that continuing into 2026. So we're seeing a substantially lower economy, less homes being built, They're more expensive, fewer cars being built, layoffs in construction and manufacturing, but maybe not a full economic collapse into a business cycle that I had predicted earlier. That's the best case. Close behind that is GDP growth in the negative 1 to 2% in second, third quarter, and then maybe some recovery after that, so that we're in recession for 2-3 quarters of this year, and we're out of it. That's the best case scenario. But that is caveated on the rest of the world believing that Trump is not going to in 90 days go, I've redone the math and it's worse than I thought it was back when I fabricated numbers on April 2nd. And so we're going to hammer you with 50% across the board tariffs. And so that if a restoration in 90 days or 4 months of what we have now would certainly put us back into recession territory. The problem is, I think most businesses internationally are looking at this, and you've got to do a critical business assessment and say, I do not believe that Donald Trump is going to not make more moves on this. And in whichever direction they go would prompt me not to want to do business with Americans.
Okay, well, I think it's probably a safe bet that things will not stay as they are today. And as that happens, we'll continue to talk about it. Dr. Hicks, thanks so much for another really educational episode.
Good to be with you, Nathan.